Good morning students. Now we are going to see about the introduction of cost accounting. Here the cost accounting mainly focuses on recording, accessing and interpreting a business cost. So each and every product we are fixing a cost. So this cost is also mainly focusing on the interpretation of a business. So for each and every business we need to fix a cost. The second one is detailed information to management team. So by fixing a cost to the product, it gives a detailed management for the decision making and for fixing the pricing of a particular product. So this cost accounting also mainly helpful for controlling the expenditure, pricing strategy and allocation of budget. So even though if a manufacturing company is fixing a price, they need to classify all the expenditure, then what are all the pricing strategy they are going to implement, what is the budget they are allocating to manufacture a particular product. After that they fix a price of the particular product. So after planning the budget, they come to the cost structure to improve the efficiency and profitability. So each and every business are mainly focusing on the profitability. For that purpose they need a cost structure. So commonly the manufacturing company mainly bases on the cost for fixing a price of the particular product. Here we are going to see about the definition. Here the definition we have a 3 point. First one is, so each and every process of an accounting will begins with the recording of income and expenditure. So what are all the income we are receiving, based on that income we are going to make an expenditure for the particular product. So the second stage is, they are giving a periodical statement which is useful for reporting and ascertaining the cost and controlling the cost. So these are the definition. So this definition implementing how the cost can be fixed, what are all the periodical report they are submitting to the management. Based on that the management will fix a price. So next the topic is, we can differentiate three concepts: cost, costing and cost accounting. Here cost, which refers to all the expenditure what we are incurred for manufacturing a particular article. For suppose if we are manufacturing a chalk piece, what are all the expenses we are doing, what are all the materials we are purchasing. So it includes all the total expenditure. So costing, which means it is a technique and process how we can ascertain the cost. So for that Arthur Weldon is telling about, we are classifying, we are recording and appropriate allocation to the expenditure for determining the cost. So the next one is cost accounting. So we know what is the meaning of cost. It is a total expenditure. Here costing is a technique and process how we can ascertain a cost. Cost accounting is, which means how we can process, how we are recording the transaction, how we can allocate, how we are reporting to the management. So these are the three differences between for cost, costing and cost accounting. Costing, which means total expenditure for particular product. Costing, which means techniques and process where we are going to implement. Cost accounting is a process how we are going to record our transaction, what we are doing in the production process. So based on that we can classify the features and objectives of cost accounting. So we have different features. The first one is process of cost. So first feature is process of cost. So we need to identify the cost. First we need to identify the process. What are all the costs we are going to implement in that particular product what we are going to manufacture. The next one is, we need to record income and expenditure which are related to goods and services. So even though whatever the manufacturing business, every business will be based on the profit. What is the income, what is the expenditure, the selling the product or purchasing the raw material. So each and every transactions will be recorded in the cost accounting. The next one is, after recording the transaction, they provide a statistical data to the management for future reference. So based on that particular data, based on the information which is given by the financial department, they analyze whether the cost should be increased or the allocation of the resources should be improved or we should reduce. So it is useful for the future establishment. The next one is, establish budget to find out the deviation. So based on the income and expenditure which is submitted to the management, they establish on budget to identify the deviation what they have. So they can identify the deviation, how we can segregate, how we can allocate a fund separately for material or labor or expenses or overhead. So based on that, the budget will be prepared by the financial department. The next one, we are going to see the objectives of cost accounting. We have 6 different types of objectives. The first one is find out the total cost and cost per unit. So after fixing the product price, we are going to fix what is the total cost, what is the per unit cost of a particular product. So here total cost, which means they are fixing the price for the total product. So based on that, the per unit cost will be segregated. The next one is they disclose a proportion for differentiating the element, how such as material, labor and overhead. So based on the cost, based on the per unit cost, they are going to classify the amount, how much we need to spend for material, how much we need to spend for labor, how much spend for overhead and the remaining expenses. After that, based on these 2 points, they are going to fix a selling price, what is the product should be sold in the market. So based on this only, the pricing will be fixed for the particular product. Next, they provide a data to the management for decision making. So based on this decision making, they are going to identify what are all the amount we are wasting for particular product. So after giving a decision making data to the management for decision making, they identify the source, what are all the wastages we have. So they can reduce the wastage and unnecessarily what we are spending for material, for labor or any other expenses which are selling the product. Next one is they compare the actual cost with standard cost. So based on this actual cost and standard cost, we can identify whether the company has earned the profit